Guys, a lot of people are wondering, have we hit a bottom? People thought we hit it in June, then it went lower, rebounded a little bit, then it went lower. So my team has given me a video from CNBC. I have not seen this video yet. I'm going to react to it based on somebody saying that we have hit a textbook bottom on the stock market. That immediately made me laugh when I heard that. So let's just watch it directly live and let's see how it goes.
Back to you. Thanks for coming on. How do we know this all just some giant short covering head fake in a downtrend?
Always possible. You got to look at the weight of the evidence. You know, again, the key reversal day, that's when you have big opening losses that get reversed into the close. That is an indication of downside exhaustion. And it's not just that reversal alone, but what's adding to its efficacy are four things. You know, one, where it occurred. It occurred at a very important level.
So first off,
on the S&P 500.
Ari, I'm sorry. You're a technical analyst. I get it. I believe in technicals. I believe in looking at charts. But that's not what we're talking about here. The bottom, what I'm talking about, has to do with emotion, has to do with valuation. Go look at the history of stock market. For him to call a bottom is an absolute ridiculous statement. I wouldn't even believe it if Warren Buffett said it. For him to sit there and say based on technicals, he might sit there and say, hey, the next month looks like it's going to be an uptrend or whatever. But to say to him, I would sit there and say, I've said this before. I think that we are nowhere close to the bottom by the end of the cycle on the S&P. And when we bring in technical, it said immediately technical analyst. I'm like, okay, we don't hit bottoms until valuations have hit certain levels and the emotion of it goes out. I'm going to go to this, guys. The emotion has to happen. We have to get people out of the market. We have to get people feeling like they can't make money in stocks. Have we hit maybe a short-term bottom? Sure. Look at the market over the last. Let's pull up the market over the last year. Let's look at the SPY. Year to date, it's down 22.19. Look at this. Yeah, temporary bottom, temporary bottom, temporary bottom, maybe a temporary bottom, but they are still met with lower lows. That's driven by valuation. Valuation's what matters in the long run. In the short run, it's people's voting machine. It's emotion. It's the short term, I love this, I don't love this. In the long run, fundamentals. And when people have given up because their emotion at that point says, I'm completely done, that's what matters for the market to hit a bottom. Not some technical analyst that sits there and says, hey, we've hit a bottom. Let's continue on. Oh, I'm already annoyed.
That's the 50% retracement of the prior bull market.
And this is what bothers me about CNBC. CNBC talks like they're investors. They're all a bunch of technical analysts, and I get that. But don't sit there and justify yourself by saying valuations. It's absolutely asininely dumb. If you want to learn about money, don't watch CNBC. They're only talking about short term. That's it. A guy like me would never be on CNBC because I'd be like, yeah, the market's going to shit. Sorry. Tim, did I just watch the next 3 minutes of this freaking video? Oh my gosh.
Bear cycles through history have been limited to. Point two, it occurred with very deeply oversold market cycle indicators.
And guess what? You can have deeply oversold. I believe that we're in a deeply oversold market right now from a technical analyst standpoint, but not from a long-term perspective. I still hear the average person saying, I'm buying the dip. Nobody's scared yet. My friends are still talking about stocks in our group chat. That to me tells me we're nowhere close.
And sentiment levels on par with what we saw in even March of 2009, levels that have been followed by above average returns. Point three occurred with indications of downside selling intensity that was abating versus where we were in June. Typically, that type of divergence occurs at a reversal point. And all this, the final point, occurring with the emergence of bullish seasonal. So this is textbook criteria, Brian. This is why we see an opportunity for the long-term investor.
Long-term investor?
The missing piece, of course, is interest rates, which has really driven this sell-off. I'd like to see that 10-year yield lower. So there is that lingering concern from a near-term
So here's
basis.
the idiot. I bet you if you ask him what's the long-term trend, what's the long-term average of the 10-year, he probably doesn't know. Guess what, pal? It's 4.4%. And we're still below that. And we were at such a low of 0.5%, 0.6%. In the last few years, the pendulum has to swing. Oh my God, this guy he sits there and says it's interest rates. It's not interest rates, it's inflation. Interest rates are a reaction to inflation. Oh my God.
For the long-term investor, we see this as opportunity.
Where's the confirmation signs? What do we need to see?
Well, let's start with the 10-year yield. Watching 3.5%. That was the June peak. So if you fall below the June peak. That's an indication of a failed breakout and exhaustion there in the rate market as well.
Tim, why must you make me watch these things?
The S&P, we can consider
the second you told me it was CNBC,
but you start to move above that 200-day average, and a lot of long.
Listen, I'm sure Ari means well, but he's not an investor. He's a speculator. Technical analysis does not care about valuation, does not care about fundamentals. I'm anti-Bitcoin. I will absolutely trade Bitcoin based on charts. I would have no care in the world about doing that. Absolutely none. But if it comes to fundamentals, that's what drives the long term of any company or stock market. Absolutely. And he is a technical, that's fine, but he can't possibly tell me what's going to matter in the next 10 years. I guarantee no technical analyst in 2008 or 2009 was saying we're at low valuation the next 10 years. They might have been saying it, but if they're right, it was because of luck. Absolutely asinine. Oh my gosh. And we're only 2 minutes into this 3.5 minute video.
Positive, and all of a sudden you have the emergence of a new bull market.
What would be a sign of failure? And I mean, aside from stocks going back down.
Right. So, listen, there's always the tail risk scenario.
Tail risk?
Perhaps you want to.
So what he's sitting here saying is like, oh, the extreme tail risk. Okay, here is the bell curve. It's the extreme tail risk. Guys, I think the market going down is here. It's not tail risk. It's the middle of the freaking bell curve. You sit there and look at stock market valuations. Guys, let me show you my freaking sheet. This is the sheet I made making my own stock market GDP ratio. The correlation was insane, negative 0.81. The range is -1 to 1. Negative 0.81 means a very, very strong negative correlation. As stock market GDP ratio is up, returns are down. Go look at it right here. We are currently 55% overvalued. Back in 2000, we were 57%. So we're almost as bad as the peak of the 2000 level. And we've already fallen 20%. And look at the future returns they got, negative 2.6. The correlation is incredible. And guess what, guys? When you're overvalued, your average return is 2.3. When you're undervalued, your average return is 9.3. And overall, it's 6.6. He's not mentioning any of that here. All he cares about is charts. More power to him, but don't talk to me about long-term. You know what he's probably talking about? Long-term being the tax long-term, which is 1 year. That's bull. That's not long-term. I'm so annoyed with this. I only got 18 seconds through that.
If you're worried about, you can't be in and out, you want to wait for the lagging confirmation, the base and turn. But even just from a trading basis, keep an eye on the June low. It's around 36.37. We're back above there today. We fell below it Friday. As long as we're above it, you have the setup for a failed breakdown below the June low. But what you're going to be looking for, Brian, really is it's not just the level on the downside, but if we start to see selling intensity pick back up and a surge in new lows again, that would have to restart.
We will see that. We will see that. And we might have a 20% rebound from here, guys. That very well could happen because that's what happens in bear markets. We've seen this before. Bear markets do this. Now, it's not just one hump, but it's all along the way like, oh, nothing can go wrong. Oh, whoops. Oh, we're fine. And I think we're here. I absolutely think we're here. Go Google the way bear markets play out. This is what happens. There's a peak. There's a trough. Oh, my gosh. Oh, we were fine, and then it crashed. But guess what? Along the way, it's this. And this is playing out exactly. Go look at 2000. 2000 went like this, the crash. But guess what? It actually did this. That's what happens. Just like in the long run for stocks, what do? They go like this, but along this path. Guys, we're at amazing overvaluation levels. Unbelievable overvalue. With the stock market down 21% this year, the S&P, and we're only now just at the level that we hit at the peak of the dot-com bubble. The peak of the dot-com bubble. And interest rates are low. They're still low relative to history, but they're not 0.5% of the 10-year. I get that. But guys, interest rates are probably going up some more. So that's your justification. You're going to have a problem.
Whole bottoming process.
Let's hear Ari.
Monday, let's be in a good mood. Leave us with some opportunity here. Chipotle, CMG. What's on the chart that makes this look attractive to you?
Chart. He's not going to mention anything about balance sheet, about income statement, about financials, about valuations, about multiples of free cash flow. And don't watch CNBC. Don't be stupid. Just if you want to learn charts, come join Mo. Mo and I do charts. I like charts, but I do my charts here and I do my value investing here. They're just different ways of making money. I do options, I do charts, I do value investing, but I don't interfere the two. Why? Because I look at them as totally different things. And charts is a great way to make some money. I know some great people who make a lot of money off charts. I did well with charts when I was doing it. Swing and long-term trading, but it's not valuation based. It's not fundamentals based. This guy is purely charts. He has no idea what he's talking about from a long-term perspective. He will end up looking stupid. Thank you very much. I'm not watching the rest of this video, Tim. Sorry.